If you're looking for an alternative to traditional stock markets, you might have thought about the OTC markets. OTC stands for over-the-counter, and they're popular among traders who are looking for smaller companies, like penny and microcap stocks, that don't trade on national exchanges. But OTC markets does not have the same safety precautions or regulatory requirements as stocks traded on Nasdaq and New York Stock Exchange. How do the OTC markets work, and what are the different tiers? The first thing you need to know is that over-the-counter markets are decentralized. Individuals can buy and sell stocks directly from one another. OTC markets are run by the OTC Markets Group, which is a for-profit financial entity. The most common stocks you'll find on the OTC markets are penny stocks and microcap stocks. Even though higher price stocks and more reputable companies also exist in the markets, getting listed on New York Stock Exchange and Nasdaq means complying with stricter trading, disclosure, corporate governance, and financial requirements. Because microcap and penny stocks often don't meet these listing requirements, they turn to OTC exchanges instead. There are some foreign companies that prefer trading on OTC markets. Because U.S. exchanges have strict regulations, not all foreign companies are willing to comply with them. They prefer the looser arrangement of OTC markets instead. So, you might find some larger companies trading on the OTC markets from time to time. While companies on OTC markets are typically smaller than exchanges, there are several other differences as well. Even though OTC stands for over-the-counter, OTC exchanges do not have any physical locations. All buy and sell orders are handled either by dealers or automatically. Trade prices are not always visible to everyone on the market. This means that the liquidity of OTC markets can be very low. Prices can swing significantly during the day, meaning that OTC markets are also significantly more volatile when compared to the largest stock exchanges. If you want to enter or exit positions quickly, you may have a difficult time doing so on OTC exchanges. The oversight of the OTC is also significantly lower than formal stock exchanges. Even though there are some rules and requirements put in place, companies should always make sure that they have all the necessary information before listing on the OTC markets. The OTC Markets Group is divided into 3 separate tiers. They include OTCQX, OTCQB, and OTC Pink. The OTCQX market is the strictest of all 3 tiers. Companies need to report certain information to the SEC, or the OTC Alternative Reporting System, also known as ARS. Find sponsorship from a third-party investment firm or bank, and disclose all relevant material news to investors. There are also stock price, market cap, and revenue requirements that companies need to meet to be listed on the OTCQX. The second tier is called OTCQB. This tier requires companies to be audited regularly, report to the SEC or OTC ARS system, and have a minimum share price of 1 penny. All companies on the OTCQB also need to have a float of 10% or more regarding outstanding shares. Finally, OTC Pink is the lowest level. This is called the Pink Sheets tier, and it has the least regulations in place. These companies must report to the SEC, but do not have to be audited regularly. Before listing, they have to file paperwork with FINRA, which can be quite difficult in itself. If you want to know which tier is right for you, call Colonial today. Schedule a free consultation and learn more about how we can help you.